Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. And the first thing I want to say is happy Monday. Good morning to everyone. I hope each and every one of you is conquering and setting your goals. And I want to be the first person, maybe not the first person, but I want to be one person to tell you, you are incredibly important and your goals and your livelihood matter. Okay, so just wanted to say that. Now, you guys, we're going to go in deep today about the bonds. We're going to go over the interest rates. What an absolutely epic morning right now. The bond yields, the 10-year right now, mortgage rates are absolutely surging like crazy right now. Something that we've been needing for quite of a long time, something that was actually put on pause, if you will, around what was it, March of this year. So, the housing market crash or reset, got postponed. So now we're starting to see that start to change. We're starting to see certain parts of the market start to fall apart once again. So really, really good stuff, you guys. And I wanted to tell you, when it comes to my live videos, I'm going to be doing a little bit of a new format. Okay. So basically the new format is we'll start by doing a market update. So we'll do the market update with you guys, do the videos. And then after the market update and after the videos, if that's, the only reason you're here, you guys can go. Because then I'm going to start going into the value part of our morning live videos. So each of my videos, I want to inject some type of value, whether it's understanding how credit works, how income calculations work, how appraisals work, something of that, something along those lines. Because the reality is, you guys, my channel fails. Real Estate Mindset and our community fails if you guys aren't learning, if you guys aren't getting value from these videos. This is more than just headlines talking about the housing market crash. I want to see you guys doing good. So each of my live videos, I will be injecting value because we need to evolve, right? We need to be powerful home buyers or future home buyers who are constantly increasing our purchasing power. So today's value is going to be credit. Now, instead of bringing up a credit report, I'm going to basically go over 6 points that are very important, by the way. So 6 very important points on credit that everyone should know about. So I'm going to go into those 6 points. And I also, towards the end, I want you to hold your questions if you guys can, but I want you guys to give me some credit questions when we're at that part of the video. Everything will be timestamped. So I want to go over your individual credit questions. You guys, I love credit. I have been doing credit stuff for so long. I became an expert. And real quick, you guys, I want to say good morning to everyone. I'm sorry if you don't like it, but I love these people. I love my viewers. You guys just keep me going. So first with Don't Move to Texas, good morning. And Mary, good morning to you. Christy, always nice to see you. Sir, nice to see you. Dean, also nice to see you. Where's my man Johnny? Vegas, I see you, Vegas. See you, Vegas. There's my man Johnny. I see you, Johnny. Johnny, what's up with Redfin? You guys, Florida Beach Bum, I wish I was more like you. Redfin still has not updated their market report. They're supposed to update their market report every Thursday. I checked this morning. Redfin's still not updated their data. I'm wondering if they're cooking the books a little bit. I don't know. I don't want to put the tinfoil on. Johnny's already making fun of me. Tinfoil hat. Anyways, Matta, good morning to you as well. Night Grace, nice to see you, man, from the very beginning. There's my man Steve-O, and I am blessed. Good morning, sir. There's Sacred, Voval, everyone. There's I'm a Day. All right, you guys, I'm going to get started right now. Good morning. Good morning. There's Scarlett, Ed. Oh, you guys, I love hearing from you. There's my man. I see you out there on YouTube, brother. You're doing good work. My man, Dental Coverage is doing good work. I see you, man. I see you trying to, educate some people. But either way, guys, where I want to start this morning video is I'm going to go into an article from Bloomberg that basically is going into Goldman Sachs and their belief that when I read this, guys, I was like, what? But their belief that the government is actually going to shut down next month. So they're going to go into the reasons why. Here's the article right here, you guys. I'm going to pull this up. Now, this is Bloomberg. I'm going to have this linked, but the problem is y'all have to get a subscription if you want to come back and reference this. So again, I'll still have it linked, but you do have to pay for a subscription. But here's what this article says. Very interesting. Very interesting, because I'm pretty sure all of us thought that, okay, the new debt ceiling, there's no likelihood that the government's going to shut down again, right? So anyways, the name of this article is Goldman sees GDP markets weathering, listen, guys, a likely government shutdown. What? Yeah, a likely government shutdown. Talk about a circus show. And I'm going to show you guys what I think they could possibly be doing during this shutdown that would help the presidential election. Again, I'm just going to read this article. I'm not going into politics. It's just crazy. Goldman Sachs sees a short-term hit to the U.S. economy with a subsequent rebound in the likely, again, they think this is a likely event of a federal government shutdown sometime after appropriations run out this September 30th. September 30th, guys, next month. Again, what? So anyways, this goes on. The federal government looks more likely than not to temporarily shut down later this year. That's thanks to the lack of consensus in Congress over annual spending bills for the fiscal year that starts in October, meaning basically the politicians are absolutely doing nothing, right? They're just arguing back and forth. It's just an absolute joke. So no one's getting anything done is basically what this is saying. The partisan divide over appropriations lack the potentially devastating consequences of the battle earlier this year to extend the debt limit. So they're saying even if the government does shut down, it's not going to be as bad if the government shut down when we had the debt, the debt ceiling. But I'm thinking to myself, like, really? We got to go through this absolute joke again? I mean, how embarrassing is this on a world stage? I mean, people are looking at the US like, what's going on? But that also makes it more likely, okay, because it's not as bad. It makes it more likely that Congress fails to act on the spending bill. Okay, this is crazy to me. You guys, it gets even crazier. Goldman's economic team calculates that the U.S. domestic product could suffer a growth hit of 0.2% hit, you guys, per week during a government-wide shutdown, including knock-on effects to private sector. That loss would be made up in the quarter after the shutdown. So they're saying it will hurt at first, but the next quarter, it's going to rebound. Okay, so that's what it's saying here. But I find it very interesting that they're saying 0.2% hit on GDP for every week. But here's what really slapped me in the face, you guys, and kind of, with a splash of cold water, if you will. Fed implications. One of the things, again, let me read the sentence for you. Okay. Just one of the consequences could be a delay, and this is scary, could be a delay in the release of U.S. economic indicators. So when I'm reading that, I'm like, oh, maybe this is just an excuse so they don't release data that is extremely important to us. And maybe they don't want to release the data because they want to, cook the books because of the presidential election next year. Again, I don't know. But that's my thought when I first read that. Why, you know what I'm saying, you guys? I mean, seriously, why they got to keep playing with the data? The fact that they keep playing with the data is super depressing to me. But let me just read this last part, you guys. Lawmakers last month broke for an August recess without having sorted the fiscal 2024 spending bill. So that's really what this is about. Or maybe it's about them getting reelected. Maybe they're saying it's about the spending bill, and maybe that's the catalyst. But if you shut down the government so that you don't have to release certain economic data, that's scary. That is scary to me. The House isn't scheduled to return until, what's wrong with these people? September 12th. So we may have a government shutdown next month, and they're not going to meet to resolve this for another 3 weeks. I mean, seriously, think about it. No wonder why they downgraded our credit. I mean, it's an absolute disaster, you guys. It's super shocking. I mean, the thing is that no one can replace the dollar. China can't replace the dollar. Obviously, you've seen their GDP. They're like 40 years of increased GDP is done. China is suffering. Who's going to replace the dollar? So I don't know that's a good thing. And this is why I say that, because these politicians are taking advantage of it. If you guys see what I'm saying, they're taking advantage of the strength of the dollar, and that's only going to last for, I don't know what, certain amount of time, maybe 50 years, who knows, but it's just really disgusting. So let's go into oh my gosh, you guys, I just went back into the 10-year right now. Oh my God, take a look at this. We're going to go into the 10-year right now, right? All right, let me get this back up here. So here's where the 10-year is sitting. In the 10-year, she's Louise. Oh my God, we needed this so bad. The reason why we need this up, you guys, is because we need to cool or crash the economy. We need to curb demand for buying, right? This has freaking exploded. We're going to hit 8% mortgage rates. We're going to hit 8% mortgage rates this year, you guys. I'm telling you right now, we're hitting 8%. In fact, some people are already getting 8%, but I'm talking the averages are going to be in the 8%. Look at this explosion of the 10-year. I think this is a new high, if I'm not mistaken, since quantitative tightening. When I woke up this morning, this was down 2 basis points. This was down 2 basis points, guys. It's shot up almost 9 basis points. This tracks the residential mortgage rates. This is what we've been needing. Remember the anniversary on my channel, 1-year anniversary this year in March? We hit 4%, followed by bank runs and then bailout, followed by like a little bit of depression for me. You know what I'm talking about? Like, geez, why'd you guys do that? But look we're where we want to be. And I'm so happy about this, you guys, because let's look at interest rates. So again, the market can't handle this type of fluctuation. This is freaking crazy. Look at mortgage rates. And I'm going to show you guys, if you take this mortgage rate, this average mortgage rate right now is 7.375. And I'm going to tell you guys, that's not counting the skyrocketing 10-year this morning. Once that 10-year starts to reflect in these mortgage rates, which it's not right now, mortgage rates today are probably going to end close to 7.5. I don't know if it's going to hit 7.5 or over, but probably close to 7.5% when this updates towards the end of the day. So if you guys want to see that, go back to Mortgage News Daily, update this. It's probably going to be more about 7.5. This is also a new record as well since quantitative tightening. So we have tightening records this morning. Congratulations, you guys, because this is exactly what we need. And also remember, on our channel, we all agreed we want 10% mortgage rates so long as prices go down. What we don't want is 10% mortgage rates and prices to stay the same. I'll bring on the 10%, but let's get the prices more affordable, right? Something more healthy, something fair, things like that. So let me show you something else. So I'm going to come back here, you guys. Now I'm going to show you guys the average person. We're going to talk about the average American now and what the average American would pay if they purchased the average house today at a 7.37% interest rate. And I'm going to show you how much money they would waste and things like that. So the first thing I'm going to do to show you guys that, excuse me, I'm getting choked up because I'm so nervous because I haven't talked to you guys in so long. So we're going to go to the mortgage payment calculator, and you guys can see I've already set this up. I wanted to save your time. So I'm putting the average home price about $410,000, whether you're looking at average or median. And I put the down payment, y'all, at 18%. The reason I did 18% is according to Black Knight, that's the average down payment. So we're going all averages here. And I'm going to show you how much money you need to make as well if you're the average American. So you guys see here, I put the 7.37% interest rate right here. The average credit score is 718. So I put the average credit score of 700 to 719. Honestly, guys, I'm just going to keep the property tax like this. If this was in Texas, the property tax would probably be $10,000. The property tax in Texas is pretty high. But anyways, the average American that buys a house right now is going to have an average mortgage payment with taxes and insurance and mortgage insurance as well, or PMI, if it's FHA, MIP, $3,000 a month. So if the average person buys the average house, your mortgage payment on average is $3,000 per month. That is crazy. And that's at a 7.37% interest rate. But it gets worse than that. I've already set this up for you guys. Again, I'm doing all averages here. I didn't want to waste your time. Here's the home price, $410,000, so you guys can see my work. Hold on, sorry. So $410,000 home price. You see 18% down payment. You all see I did that right there. And here I put 7.375. Because that's how it's ran. You see, I can't do custom interest rates here. So I'm going 7.375, which means the average American, okay, that buys the average house at the average interest rate right now is going to pay $120,000 in interest in only 5 years. That's crazy. That's absolutely crazy. And they're locked into a $3,000 payment unless they refinance. Now, over the life of the loan, and probably they will not pay 30 years on this mortgage, so I don't like to talk about the life of the loan, but I think it is important to note that if you guys buy a house today, the average American today, okay, is going to pay $500,000 in interest on a house. The average American today, again, they're not going to pay it for 30 years, but let's just act like they pay it for 30 years. $500,000 in interest. Doesn't rent sound a little bit more okay? Now, we don't want to get stuck renting. I'm not saying we want to get stuck renting. That's what I'm saying. There's going to be value in every single one of these videos because we need to evolve. But I want to point out $120,000 in 5 years on average, you guys. And remember, look at, that's with an 18% down payment. That's an 18% down payment with a 700 or 718 credit score, which is a 700 tier of qualifying. But 718 credit score. This is bad news, guys. You want me to show you what it was at 3%? No, it doesn't even go down at 3%. Let me show you the next thing. Look at this. Okay. I've already set this up for you guys. Again, I don't want to waste your time. This is how much money right here the average American needs to make in order to afford the average home. Let me show you how I did this. All right. So I put the same down payment. You see that? $73,800. Now, here's the thing that's questionable. Okay. The average debt for household is probably more than $1,400. I'm using a $1,400 monthly debt payment because I'm with only one borrower, right? And I'm only calculating average credit card payment, average car payment, an average school loan payment. Total of all of that for one person, on average, if they have all of those things, and it's not a new car, a used car, $1,400 a month. That's so depressing. But I want to point out again, I still think $150,000 is a lot of money to make a year. I'm going to be honest with you guys. I'm not balling. I'm not rich. I'm none of those things. I think $150,000 is a lot of money. In fact, that's more money by far than I make at my corporate job. Remember, I have a corporate job as well. I'm a loan officer. I'm a realtor and instructor, but I also have a corporate W-2 job. This is crazy. $150,000 is what you need to make to purchase the average house. You guys surprised about that? I don't know. I'm surprised about that myself. I'm surprised about that, you guys. We're going to go into our first video right now. I'm just going to do the timestamp real quick. Let me know if you guys are surprised about what I just showed you. You guys should be experts by now if you've been watching me. We're going to go into our first video, you guys. And the first video is basically, it's basically going to talk about if the rates don't fall, there's really no upside in the markets. The markets are extremely questionable. We're probably going to start saying, I don't like to talk about stocks because all I do is lose money in the stock market. So I don't like to talk about stocks, but we're missing essentially two things right now from like total devastation, like Great Depression status, which is a total stock market collapse and unhinged unemployment. But again, we see these headwinds in the future. We see all of this stuff going on right now. So we're going to go into the first one about interest rates needing to fall significantly in order for really any balance or benefit to even come back to the market. But the thing is, guys, is I doubt that we'll ever have interest rates in well, let me take that back. I hope that we never have interest rates in the 3 and 4% again, because if we really are honest with ourselves, we really can understand that the reason for all of these problems is not the high interest rates that we have right now. The reason for these problems is because we had low interest rates for too long. We were supposed to only have low interest rates because we were on lockdowns from COVID, remember? But anyways, guys, let's play this first video. Let me know that the audio is okay.
Right now, we're seeing the futures bounce up higher. What do you make of this, what looks like it could be a rebound for the start of this week?
Well, it certainly comes after the sort of surprise rate move on the longer end of the yield curve that in conjunction with selling in some of the big cap tech stocks post earnings was enough to get that pullback, and now we're seeing a little bounce. But unless rates fall notably, I would question any sustainability on the upside and would be more focused on what the potential downside is. I think markets got very comfortable with the downward trajectory of inflation, deservingly so, and believe that the Fed is almost done raising interest rates, which I think they are. But this long end rise in yields caught many by surprise and changes that calculation and shakes up that complacency.
So I really want to focus on today, Peter. So you're saying today you see another difficult day for the markets. I'm looking at the 10-year, just about 4.28 right now. Does that continue to weigh on the market, specifically technology, or do you think other areas are also impacted?
Well, I think there's definitely a flow through with the rise in rates to all other asset classes. Stocks could rally today. They can rally through the week for sure, particularly after what NVIDIA is going to say on Wednesday. I just think in order to get a sustained rally from here, you need a fallback in rates, particularly on the longer end. If longer end rates remain sticky here above 4%, I think that an equity move higher is going to be tough because we now priced at a pretty high valuation, 20 times earnings with rising interest rates and very mediocre earnings growth, if that. In fact, we're actually seeing an earnings recession. That's not necessarily the cocktail for a big move higher in stocks, and there's more risk to the downside instead.
All right, so Peter, you're seeing some softness in the market right now. And with that in mind, what is your WEX word of the day?
It's rates.
That's not a surprise. We've said it about 20 times already.
Yeah, I think that's bottom line. And as I said, it's the rate move higher on the longer end, which is market driven. I think is the main factor here because it's not necessarily happening for all good reason. I think the big influences have been the Bank of Japan widening yield curve control, the massive treasury supply at the same time Fed's conducting QT. And in fact, a lot of central banks are doing QT. Then you also have the lack of foreign central bank buying, banks that are not buying, offset by retail and institutions, but that are mostly buying shorter term treasuries. So it's not because we're seeing this sudden acceleration in economic growth. Now, some people are comfortable that maybe we don't go into recession anytime soon.
So,
but I think some
Peter,
of these
let me
other
jump in. We're really focused on U.S. rates right now. We're talking about it, but there's also a big story today in China not cutting rates on a key lending rate there that really impacts the property market. So how does that make you look at the property market and other Chinese equities today? Do you believe there's even more downside pain to come? Would you perhaps buy the dip today, or would you just stay away from Chinese equities today?
Well, China's residential real estate distress on the developer side is going to be a multi-year process. The positive is that they're hopefully cleansing a lot of these over-indebted developers. Now, cutting interest rates for them, maybe it'll help slightly on the margin in terms of incentivizing demand from consumers to buy and absorb a lot of this excess supply. But we do get to a point where they're pushing on a string, and little tweaks here and there, 10 basis points, 15 basis points, and rate cuts is not going to really do anything.
All right, Peter, almost out of time. Very quickly today, is there a sector that you would put money into, or an area of the market you would put money into?
We're still bullish on long energy stocks. I think oil prices, while they've had a nice move higher here into the 80s, I think they go much higher over the next 6 to 12 months, and we'll be buying energy stocks.
Alrighty, guys. So that's the first video. I like that video. Finally, we're listening to someone that makes a little bit more sense. I know we stick with CNBC, but they have a lot of videos, you guys. I mean, he's pinpointing. He's like, you guys, the rates are really high. risk. The market's softening up. China's all, like we talked about in the beginning of this, China's already being devastated as far as their housing market. Their housing market is melting down, you guys. Evergrande just filed bankruptcy. Was it Chapter 15 bankruptcy? I think on Thursday in New York, if I'm not mistaken. So a lot of stuff going on in the world. Let me show you guys something super crazy real quick. I want to get your thoughts on this. This is the reverse repo market. This is, for a lack of better description, you guys, this is where banks are putting the deposits, and the reverse repo market is like a one-day treasury. So I buy 1 month treasuries, and I buy them in blocks of 1 week. So every week I have my T-bills maturing, so I have constant cash flow. But this is the 1 day. And what is really crazy about this, you guys, is it's been going up again. So since about, let's see where the bottom was. So since about July 18th, this has been going up, and the Fed wants this money. So I'm wondering, is part of the reason why well, first of all, there's many reasons why the 10-year is going up. It's ballooning. It's skyrocketing up. It's like almost like it's unhinged right now, which is good. This is what we want. But I also find, I think that this may be a contributing factor, is my point, because this is going up. So the fact that this is going up, this means that the banks don't want to buy treasuries over 1 day. You see what I'm saying? If they, if we see this start going down, they're going to be taking the money from the 1 day, probably, I don't know for sure, but probably going to go into 6 months, right? Or possibly 1 month, maybe even 2 year. But I want to point out, y'all, it's trending up. It's barely trending up. If we look here, it kind of passed that August peak. You see that? So we have a new high from August 7th. This is very fascinating to me, you guys. There's so much happening right now, but the reverse repo market is going up and not going down anymore. And look, it's skyrocketed downward from about April 28th. Boom. Look at this. All this money right here, you guys, flowed into basically treasuries. I don't know if it was 2 years, 6 months, who knows, but all this money flowed into treasuries and then again stopped. Flatline. Intriguing. Let me show you what the market's doing now. So this is a CME FedWatch tool. This is a good indicator, as well as this went up. That's crazy. This is a good indicator because a lot of people are like, when's the Fed going to cut rates, right? And it's so hilarious to me when I hear like, I don't want to say like realtors, because I appreciate some realtors very much, especially if you're in my life. If you're in my life as a realtor, it means I respect you. But, and this goes to loan officers as well, it really drives me crazy when people just at the cuff, they just, rates are going to go down this day, or rates are going to go up this day. It's like, what are you basing that off of? Because here at Real Estate Mindset Community, we're going into data and we're looking at the market and basically seeing what they're saying. So I'm going to tell you guys right now, the market tells us they're not going to cut rates until next year, at least probably around the second quarter. What would change that? Black swan will change that. Collapse changes that. So I want to point out that as far as September rate hike, it's gone up. Look, it has gone up. It was sitting at all last week, I think at about 11% all last week. It has ticked up very, very slightly. So they're saying, nah, there's not going to be a rate hike in September, but we'll give you 2% more likelihood. Look at November. November is starting to price in a 25 basis point rate hike. Let me move my picture. I'm so sorry, guys. So September has gone up. I'm sorry, November has gone up as far as the likelihood of a rate hike. You see that right here, the 550 to 575. That would represent a 25% rate hike. This one over here, you guys, would represent a 50 basis point rate hike. So they're starting to talk now about a little bit, right? Just whispers of 50 basis points. It's probably not going to happen, but little whispers. Anyways, 36.3%. They're starting to price it in. Let's look at December. December, same thing, kind of, up as well, 33.6% in December. Again, they're pricing in 3.9% chance of a 50 basis points, but also look at this. They're pricing in a cut, a 5% chance of a cut in December of 25 basis points. The general consensus being pretty much we're going to be at 525 to 550. Again, if they raise rates, all of this will change, obviously. So if the rates go up or down, this whole bottom here changes, right? Let's look at January and see what they're thinking January. So here's where we're sitting right here. So in January, they're still thinking we're going to be sitting right here with a 20. This is so crazy, you guys. So this is what the market's saying about January. So January, 26% chance of a 25 basis point hike, but also a 17% chance of a 25 basis point cut. Now, remember, you guys, we want to make it to June or July. If we can make it to June or July, I think we're going to be good. Probably recession is going to hit. If the recession hits, it's going to crush next year's buying seasonality, which is what we need. We need next year's seasonality for buying to be, I mean, it was crushed this year, but we need it even more crushed. We need it to stop, right? It was crushed this year and it still roared back. Let me show you guys March. So March, 31% chance of us 25 basis points lower than what we're at right now. So 31% chance. Look at May. May 36 right here. You guys can see that. And honestly, let me explain. These numbers will get greater on the cut side the more bad things happen. So don't get freaked out if you start seeing these adjust and the rate cuts looking nearer, because if they're projecting rate cuts to be sooner, that means something very bad is happening, you guys, and that's what we're talking about. There's a lot of stuff in the background happening right now, a lot of stuff that it's really difficult to understand because there's so much. But anyways, let me show you guys June, and this is where I want to make it to, y'all. I want to make it to June. Market saying a cut of 32% chance, 25 basis points, but a 50 basis point cut in June of 30%. Again, I want to make it to July. July would be amazing. So July, so you guys can see here, July is like, the market is saying, okay, just to be specific here, the market is saying, and it is pricing in, there's going to be cuts starting in July, anywhere from, look at this, is crazy, anywhere from 25 to possibly even 75 basis point cut in July. Again, you guys, that's going to really depend on what? The bad stuff, black swans. But I thought that was interesting to note there. The market's all over the place. The one thing that I'm pretty sure that everyone's starting to realize right now is we're not going to be going to low interest rates anytime soon. And the fact is we don't want to have low interest rates anytime soon. What we want is the housing market and shelter to be affordable for the average American. The average American is priced out of the housing market in almost every single state by far. And what we need, in my opinion, you guys, and what I'm hoping that we get back to an environment and we get back to a housing market that is so balanced that the average American can qualify to purchase a house, right? Can afford to. We don't want people making $150,000 just to purchase the average house. Do y'all agree with me? Comment below. Let me know if you agree with me. Let's go into our next video. Again, you guys, we're going to go and talk about why are the yields on the rise. This is exactly what we want. So if you want to understand why this is happening, pay attention to this video. Definitely appreciate you guys. Here's our video number 2.
Help us make heads. Is this a once in a lifetime chance to buy higher yields or no?
Well, I think yields are going up because the market is not completely convinced that inflation is behind us.
Okay, I'm going to pause this because I want to take note. Do you notice now, you guys, that we're listening to commentary from people that are starting to pivot? Okay. These guys are starting to pivot, and I hope you caught that. All right. Let's keep going.
Now, it's not worried about 8-10% or Zimbabwe inflation, but it is worried that we might be in a 3 or 4% inflation world.
Jeez.
And if we are, then you could be looking at bond yields that will be settling in closer to 5% than to 4%. And that's what you're seeing with the 10-year yield and with the 30-year yield. They're starting to drift towards that target. And ironically, it might be because the Fed has backed off of tightening that the bond market is starting to get nervous. If the Fed's not going to fight the inflation fight, then it's going to fight the inflation fight by selling off bonds. So I think that that's the big picture. That's what's been driving bonds for most of the last several months as they've been moving higher.
Ron, I sense you don't agree here.
Not entirely. I don't disagree fully. I also think the
more
bond
rate
market
hikes.
has not ruled out the possibility the economy will avoid recession completely and maybe accelerate rather than decelerate, whether or not inflation goes back up. You look at the Atlanta Fed GDP nowcast, 5.8%.
But they've been high forever.
They've been high. And look, they could be 2 or 3% high at 5.8%. You're still coming at, 3.8% annualized rates of growth in third quarter. No one expected that. Everybody was looking, myself included, a couple of weeks ago for sub 1%. That's not happening.
But let me get back to Jim's point here, and that is that maybe the inflation fight isn't done, and that we're not going back to a 2% inflation rate. We're going to a 3 or a 4% inflation. Doesn't that suggest that the Fed will have to do more? Will have to raise longer, raise more, keep them higher longer? Something I think you've said they don't need to do necessarily.
Yeah, I think if it's a 3% inflation world, they don't have to do more because you have 200 basis points, 250 basis points of real interest rate built into that, which is a relatively restrictive policy. And if we, it's interesting, Tyler, if we go back, a decade, right, where we spent 12 years trying to get inflation above 2%, and then the Fed started talking about average inflation rates. If we were at 3% for some period of time, if you X out the pandemic and the immediate response thereafter, you'd kind of be where the Fed wanted to be in the first place, which is having an average inflation rate where it's been historically at about 2.5%. So I think, I think there's more growth
2.5
being built in, less recession being built in. Inflation, I'm not sure about. I still think, with the exception of a couple numbers in the next couple months, it may be sticky. It's still coming down.
Jim, I guess we have to talk about, on the short end side of things, it's really just about what the Fed does with rates, how long they leave them high, when they start cutting. You think Jackson Hole will shed some light on that?
Well, it should. That's kind of the big speech of the year where Chairman Powell or whoever the Fed chairman is kind of gives their long-term outlook. Remember, a year ago was that famous 8-minute speech where it's been dubbed the will be pain speech. And subsequently, there was never any pain. And unemployment rate came down and stock prices went up. But I do want to come back to something that Ron said. I agree that a part of the equation here is that the economy is doing very well. And you're seeing that on Wall Street. They're all throwing in the towel on their soft landing and recession forecasts, and they're upping their forecasts. But that could be fostering, too, to an excess demand or extra demand that is pushing in prices higher, which is inflation. And so the market, I think, is getting more and more worried that we're going to be in, if you add real growth plus inflation, a high nominal world. And that's what these interest rates are reflecting. Furthermore, if you just take a look at 5% or 4 or 5% interest rates, if the economy is accelerating, it's a big sign that these rates are not restrictive. We could go through models and say, hey, look, they should be restrictive. It's 200 basis points above this or that. It's not, because the economy is accelerating and it's telling us in real time that it's not hurting.
All right. So there is our next video. And you guys, let's talk about interest rates real quick. And you guys, when did I start saying this? I think I started saying this like July or August of last year, but I don't think again, what do I think, right? I hope that rates don't go back down under 5%. If hopefully we get enough inventory over the next maybe 3 years to 7 years, we get enough inventory where we can keep interest rates 5% or above, that would be so good for us. That would be so good for our economy. That would be so good for our housing market, you guys. But we need the prices to correct. It doesn't matter if the rates are doing so far have done very little, except for new homes. Existing homes, no, not that much, except in Austin and some other places. But new construction is essentially getting wiped out in a lot more areas than just existing homes. So new homes, you guys, watch for that. And I just did a video yesterday just to really point out just how many listings of new homes there actually are. There's like a historical amount of new home inventory right now that a lot of people aren't taking into consideration. I mean, that's why I literally flew around the nation last year and the beginning of this year. And I plan on doing that again, you guys. I have a lot of stuff to go over with you, but I want to show you now the market and the 5-year break even. Look at this, guys. This is okay. So on one hand, they're saying that we're beating inflation. Okay, right? I mean, we see comments on my channel, we're beating the inflation, blah, 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 blah. But on the other hand, we also looked at the reverse repo market. The reverse repo market, maybe we should have higher rates so we get the money out of the reverse repo market. But look at this. This is the 5-year break-even inflation rate. It can't go down. This here is telling us, as long as that goal, the Federal Reserve's goal of 2% inflation, okay, if they change their goal, everything changes. But as long as Jerome Powell keeps that 2% goal, we are not there. And the market is also saying we're not there. It is going down though. So we got a new low. The last low was the last dip was August 9th. We just passed that dip. Okay. So maybe it's going to start trending downward. This is a 5-year break even. We're sitting at 2.2% right now, or 2.22%. This needs to go to under 2%. When this goes under 2%, this should signal to the Federal Reserve, in addition to other things, that it's okay to start cutting interest rates. So this is going to be watching the Fed. This is something that watches the market, this watches all this stuff, and this is the chart right here, okay? It's 2.2%. We're not there yet. This is, again, one of the forms that's going to say, keep hiking. We're not done. And that last video that says, Jerome Powell promised the pain's not here yet. He's right about that if we're specifically talking about the housing market. But when he's saying that we haven't felt the pain yet, that's ridiculous. I can guarantee you guys that there's tens of millions of people that have felt the pain right now, especially if your plan was to purchase a home and you just got priced out. You're probably stressed out. You probably have anxiety. You're probably saying, I missed out on the best opportunity of my life. You're depressed. Stop. Consider yourself lucky. I'm telling you guys, consider yourself lucky. Remember, the Federal Reserve is doing this on purpose for a reason. There's a reason. Remember, you guys, stay your best friend. Okay, don't beat yourself up. That's all I'm saying. Let's go into our next video, you guys. Again, we're going to go into more about the interest rates. I'm going to do it like this so you guys can hear the audio a little bit better. This is a good video as well. I'm going to do my timestamp. We're getting to our value here shortly. But again, we just have a huge day of interest rate hikes. So let's see what this has to say.
Urian Timber joins us now to talk about it. Urian, good to see you. I know you've been doing plenty of work trying to break apart exactly what's going on in the bond market, what yields at these levels are telling us for perhaps how restrictive, the bond market is against the economy, what it's going to mean for risk assets as well.
Yeah. So good morning. So about, at the October lows last year, the market started to sort of pivot from one narrative, which is, the Fed is raising the cost of capital. And when that happens, the present value of future cash flows goes down. So bond valuation math stops working. The equity valuation math stops working. So that was the story for 2022. And then late last year, the market got pretty oversold. And the stock market decided to move on to an earnings recovery narrative. And typically, in the first 2 to 3 quarters of a market cycle, you see that recovery play out with rising PE ratios, which is exactly what we've seen, right? Earnings are still actually declining, but they're starting to decline at a less bad pace. Not that it was bad to begin with, because earnings are only down about 3% year to date. But the market's moving on to that recovery narrative. And as typically happens, the first phase of that is all PE. And so the PE ratio, which was 15 in October, is 20 now. The market has kind of front run a lot of good things that are supposedly going to happen, but now they need to happen. And on the earnings front, I think that's generally playing out. But as you mentioned, on the interest rate front, the bond market is giving the Fed giving the market some indigestion here. And I think ultimately it comes down to this whole kind of esoteric concept called the term premium. And whether the term premium really deserves to be negative, because historically it tends to be positive. You think about a term premium is the compensation that investors want to get paid for owning long-term bonds. And that could be a credit premium for corporates. It could be an interest rate premium, an inflation premium. And typically the term premium is positive, but it has been negative, and it's still negative despite fiscal deficits, despite, foreign currency intervention in China, And so I think that's really what's driving yields higher here. And the market has kind of moved on. And I think this is a wake-up call that maybe it's moved on a little bit too much.
Interesting.
So what's gone on a little bit too much? The stock market had kind of gotten too far ahead of itself relative to the cost of capital, relative to where risk-free rates are. I guess the question is, we're in this zone right now of talking about these invisible kind of factors in the bond math, right? We have the neutral rate. You talk about the term premium. We're talking about potential growth levels in the economy. What does it mean, in your view, bottom line, for the stock market? Just as everybody got comfortable calling it a bull market and calling for a soft landing, we've had this gut check.
Every time.
Yeah, and I think the bull market narrative still stands, but the market kind of rallied in a pretty symmetrical channel. It got to about a 20.5 PE. If you look at maybe a 50% retracement down to the 200-day moving average, that gets you an S&P of around 4,200, 4,150. That would be an 8-9% decline from the peak that we already saw, but certainly not the end of the world. But you raise a good point. R-star inflation expectations through the TIPS market, these are all just assumptions, right? So when the Fed is at 5.5, and we assume that R-star is at 1.25, and you add inflation of 2.5%, which is the Fed's target for the CPI, you get to a sense of the Fed's pretty restrictive. But what if R-star is higher? What if the TIPS market is wrong? And this is what makes investing in real time so difficult, because you're always dealing with assumption. And on the valuation side, you have the same thing, right? It's like, what kind of earnings growth do you plug into a DCF model? What kind of risk-free rate? What kind of equity risk premium? And so, this is kind of the point. And it's one thing if we're sitting at the lows in October, where really nothing good has been priced in yet. But now we've had this 5 PE point rally, an almost 30% rally, based on the expectations that certain things are going to happen. And now they need to happen. And if they happen, but maybe later or not as much as the market thought, you get this indigestion. I think that's kind of what's happening here.
Yeah.
Okay, so I think, do you guys find it, okay, first of all, I'm getting excited because I don't know for how long we've been doing these lives. We had to listen to CNBC bring on people. Yeah, it's a bull rally, GDP, the labor market. And we just listened to 3 separate videos of people that are essentially flipping. It's not a full flip maybe, but thank God we are starting to get people that are like telling us like, hey, this is actually pretty shady. We're paid to be bullish. Okay, because that's what I heard. We're paid to be bullish, but this is shady. But this is crazy what's happening. We're worried, risk. There's risk everywhere, right? And I believe, you guys, the market is finally, once again, starting to feel the pain. I believe the market already started to feel the pain last year, but again, bank bailout, fine, whatever. We keep talking, a dead horse there, okay? They're starting to feel the pain. We're seeing that. We can hear it. I can sense it from these people. And maybe one of the reasons is, take a look at this as well. This is the inversion of the 10 and the 2 right here. Okay, this is the 10 year, this is the 2 year. This is what we watch. This is our economic indicator of a recession, essentially. Now, I want to just point out the depth of the reinversion. So the surge upward. Now, remember, we were like way down here. This is basically what I'm trying to point out, you guys, is how inverted the 10 and the 2 year are from each other. And the fact that ever since about July 3rd, it's been skyrocketing upward. Now, the reason for this reinversion is the long-term yields have been going up. The 10 year has been going up. So, and that's actually a good thing. That's actually what we want. We actually wanted to see that. Now, here's the thing. Say the 10 year keeps going up. Listen, guys, if the 10 year keeps going up, this is going to keep reinverting. And remember, generally, listen, generally, before we have the recession, we're uninverted. Okay? So but it's also possible we are in recession right now, because during the 70s and 80s, we stayed inverted. But I'm just letting you guys know, since then, since the 70s and 80s, we've always reinverted before recession. But I think, again, it's still important to note that it's possible we go into recession while being inverted, because the last time that happened was also an inflation crisis, right? But it's very intriguing, you guys. It's skyrocketing upward. It's happening. I mean, my gosh, it's all happening right before our eyes. I mean, we're a little off on the, I was a little off on the timing. I was definitely off on the amount of toxic home buying, but geez, I mean, it's happening in front of us, you guys. This is finally, right? So we're going to listen to one more video, and then we're going to go into the credit. We're going to go into the value. And basically this video is going to go into how unhealthy the housing market is. I mean, these videos, you guys, have basically flipped overnight. So now they're going to say, listen to this video. I hope you guys like it. Okay, let me set this up for you guys right now. If you guys can, let me know that the audio is okay.
Realtors sounding the alarm. If the economy continues to show strength and the Federal Reserve hikes rates again, we could see 8% mortgage rates. Our next guest says that is bad news for housing demand. Joining us now to talk about housing affordability is Logan Mohtashami, Housing Wire lead analyst. Logan, great to have you with us.
This guy drives me crazy.
It seems like a lot of things start to happen even when mortgage rates are at 7.2%. I mean, people are less likely to buy because affordability is terrible at this point. And I would imagine that it also puts in a difficult position home builders, which had been buying down mortgages.
Bingo.
Just makes the whole venture a lot more costly and pressure.
You guys, real quick, I just wanted to point out, I forgot to mention this. These rates going up like this are murdering the profit margin of these builders. Murdering. Because remember, like, for example, Lennar's offering a 4.25% in my own local housing market. For them to do that probably costs $50,000 to $60,000. Just give it to me on the price. Why won't they give it to us on the price? Because they don't want to destroy the entire community that they just built in. If they drop the price, they burn all those recent homeowners. Sorry for rambling. Back to
well, first world problems. The economy is doing well, and because of that, mortgage rates are rising. But definitely, when mortgage rates got past 6% last year, we had the biggest home sale crash ever in history. The builders have been very, very creative on pushing rates down, but that could only go so far. So, of course, right now we're dealing with higher home prices and higher mortgage rates. It's a very savagely unhealthy housing market, and not much is going to change unless mortgage rates start coming down, because 5 of the national home price indexes are at all-time highs currently.
What are you forecasting in terms of mortgage rates? And this is, we cite usually the average rate, but this is for people who have average credit scores.
Nope.
I mean, plenty of Americans are already seeing 8% when they are quoted when they go for a loan.
I'm a 10-year yield guy, so if the economy stays firm, bond yields can keep on rising higher. I think the Fed is very happy with real yields where they are right now. So if the economy stays firm, rates could stay up here. But the bad side is nobody's moving, right? New listings data is trending at the lowest levels ever. So a lot of people are just waiting until mortgage rates come down a little bit lower to, maybe do their transaction. So the higher the rates go, the lack of new listings data should stay with us. So it's a waiting game. And you have to remember, the Federal Reserve is trying to help the economy by pushing rates up. Credit cards are going up, car payments are going up. The best hedge not only against inflation is your 30-year fixed mortgage, but your best hedge against the Federal Reserve was your 30-year fixed mortgage. A lot of homeowners are just sitting with very low total housing costs. That doesn't change unless mortgage rates come down or home prices fall. And inventory is too low to have any kind of major home price crash anytime soon.
So at what point, Logan, do we need to, are we going to see a significant slowdown? You mentioned, way back when we saw a jump in rates to 6%, that we saw a crash. Where's the crash now? Is that going to happen? I mean, because ultimately bad news is good news in a way. A crash can actually put more,
look at them.
Units on the market. Here's the confusing part for a lot of people. Housing costs are more expensive this year. However, home sales aren't crashing anymore. My theory is that we got down to 4 million. It's really rare in America after 1996 to get existing home sales under 4 million. So we've killed the marginal home buyer. What is left is really the prime home buyers that are left in America. Home sales should be going lower, but the velocity of the crash just isn't there yet. You're probably going to need much higher rates for something like that to occur. But we already crashed in sales last year. So I think that's the confusing part, because it's more expensive to buy a home now than last year, and home sales are pretty much kind of stuck. But we have to realize we have over 156 million people working. 4 million monthly home sales isn't that much. So in that context, hopefully that explains why home sales aren't crashing anymore.
What are rents doing in this environment?
Well, the growth rate of rents are slowing, but again, that's just the growth rate. Rent inflation is still very high. It's just that in a lot of places you're starting to get more supply. That's good. That's a positive.
Oh, we are getting more
hopefully
supply?
all those apartments that are under construction comes onto the market. The best way to deal with inflation is always supply. So you're going to have choices for a lot of people where they need to be in shelter, and more supply will cool down the growth rate of rents, but it's not like major rental deflation nationally. We rarely get rents going negative on a national basis post World War II. So you alleviate some of the rent inflation, but we have to be realistic here. It's not like rents are dropping nationally in a very big way.
All righty, you guys. So this guy, you know, even though you guys could probably tell how incredibly bullish he's being, they're starting to get it. The market's starting to get it. They're starting to they got no choice. I'm pretty sure they could see what's going on. I'm pretty sure that's why one of the reasons why Redfin right now has not given us our, their housing market report. And I find it so suspicious because that's when value's starting to go down now. So right when value starts to go down by a considerable amount in some cases, they start withholding the data. What? Anyways, I'm very suspicious, you guys. We're going to move on to the next part of this video, but there's a couple people I saw what's going on in the chat. You guys be nice to each other, please. But just wanted to give some shout outs real quick to, where was it? To my man right here, spitting some stuff. Also, I see you, Mr. Wilson? Was it Mr. Wilson? Hey man, for all the veterans, I just want to say, man, thank you guys for your service. Thank you for what you did for our country. From the bottom of my heart, I wanted to say thank you. You have my respect. All the veterans. Appreciate you guys. All right. Stop fighting in the comment section, you guys. But let's go over talk about credit. So if we can now, please start throwing some comments up about credit before we really dig into credit. And I want to make 6 points about credit, how credit score works, how to get higher credit score, and basically just an overall understanding of credit. It will be fast. I also want to take questions. So again, if you guys can shoot some questions down there, specific about credit, whatever you want to know about credit, shoot them to me. So as you guys are preparing that, let me throw up 4 comments that I got here. One was from Ima Day. She's like, Trav, seriously, who do you think is buying homes still at these ridiculous prices and this interest? I'm going to tell you, I'm the parents of millennials. If we look, I mean, there's a lot of cash buyers right now, and I think they're getting help. We know. Well, here's what we know. Let me answer this question this way: we know the average Americans are not the ones buying houses right now because we know for sure, 100%, that the average American can't buy a house right now. So we also know the unaffordability. We also know the equity run up. So the only people that are buying right now is either like gifted money from their family or whoever, or the second thing, the most well-qualified buyers. Which means when it's my turn to buy, there's going to be way less qualified buyers because a lot of those well-qualified buyers jumped off the sidelines, got nervous, whatever it was, and they went to buy a house. And I'm not confusing, like, for example, what Jeff did, right? Jeff found a house that he loves. He purchased it all cash. I'm talking about people purchasing real estate based on emotion. I'm not talking about investors, right? I'm not talking about, well, first of all, I'm not talking about savvy investors. There are still investors that are investing based on emotion, you guys. So that's a really good question, Ima, but I could tell you one thing. It's not you or I, the average American. Another comment here. There is no way we have an economic collapse coming into the presidential election. They won't let that happen now until 2025. And I've thought about this, guys. That's scary. So the reason I'm bringing this up is it does scare me. That's something that scares me. And I think that honestly, I think that's what we're seeing right now. How many revisions have we seen to the data? Downward revisions, right? I mean, there's a pattern here. That does scare me, Dad, which is why we have to not get lazy. We can't get complacent. We don't want to be trapped on the sidelines. We want to continue empowering ourselves and things of that nature, obviously. Third thing, and we're going to get into this here in a minute. They don't think about prices. They think about payments. They buy payments. The reason I brought this comment up, you guys, is because I understand that the media and society right now is telling us the most important thing in the housing market is payment. I know it feels that way because of rates going from 2% to almost 8%. But the reality is the price is more important. And it's easy to understand that when we talk about all cash buyers. If you have all cash for a property, what's more important? Your no payment or the price of the house. The price of the house is always more important. Plus, you have a possibility, it's not 100% guarantee, but a possibility to refinance into a lower rate, possibly in the future. We're talking about price here, you guys. People are buying overpriced houses, and realtors are saying it's okay. A lot of realtors, not all, but a lot of realtors are saying it's okay, buy an overpriced house. It's going to go up in 10 years. That's so dangerous. That's so dangerous. So you really need to look at the price, not the payment. Now, this is from Charles. Okay, so Charles says, if the only way home prices go down is mass unemployment, then are we rooting for the wrong thing? The thing is like, and the reason I want to bring this up, guys, is think about what he's saying. He's right. I'm rooting for a balanced housing market, but and this is why we got to really be careful with how we treat other people, especially if we're ahead of them. People got to get hurt, you guys. People are going to get hurt, and there's no doubt that people will get hurt. That's why I've been screaming from the rooftops, like, you guys, please think about what you're doing. Make sure you love it, you can afford it. Wedge cash flow, because people are going to get hurt. People are going to get hurt, and again, I think the mass unemployment is coming. I think that's one thing that is missing, but I don't want people to get hurt, Charles. I'm not rooting for people to get hurt. I'm rooting for people to be strong. I'm rooting for people to weather the storm. I'm rooting for people to be so aware that they could do something about it, man. I'm not rooting for people to get hurt, right? I didn't create this, brother. I didn't create this. This situation is sad to me. And I have empathy for these recent homebuyers. I get roasted on my comment section all the time. Like, Travis, who cares about these losers who just bought? Who cares? The fear of missing out. I care about these people, even if they recently purchased recklessly, because I was one of those people, you guys. I was one of those people. So I have empathy. Sorry. Thank you for the super chat, Delta. Japanese dental college student here. Interesting. I am wearing financial crush in 1991 in Japan is happening, but in US and China. You should be aware, brother. I don't know about worried, but yeah, look at what's happening in China. Look at what's starting to happen again in the US. It started again the beginning of this year. It was reversed, and then the seasonality really kicked it up. But I think, Delta, one really important thing for people, like if I was in your shoes, man, is you just buckle down, brother. If you're far from being, able to buy a house because you're in college still, like, I want you to take notes, and I want you to take notes and never forget what happened. Okay. This is like a once in a lifetime thing. Never forget what happened, and never forget how the professionals, the powers that be, the media failed us all. And why is it important to know that, you guys? Because we can only count on ourselves. Remember that, okay? So let's go back to the live real quick. I'm going to throw up hopefully some credit questions here. Did you guys throw up some credit questions? All right, so darn it. I have 76 comments since I asked that questions last. Oh my gosh, I messed up. We need, okay, there's some, where's the credit questions, you guys? Throw some more credit questions up. We're going to go into the credit section right now, you guys. So I want you guys to throw up some credit questions. I'm going to go over 6 points, but please, if you've already put a credit question up, throw it up again, because it's too deep to comments. So I want to go over 6 points real quick. It's very important that you guys pay attention to what I'm about to tell you, because this applies to everyone's credit. And I've known people with an 800 credit score that had no idea about some of the things that I'm about to say. And if you guys, again, throw some question up, put question, and then put your question there. But number one thing, okay, when it pertains to your credit, is utilization ratio is king. Utilization ratio is king, and it only applies to your credit cards. That's my beef with Dave Ramsey. I believe Dave Ramsey should be explaining to people, actually, you could have much greater purchasing power if you understood how to increase your credit, right? Your credit has to do with your purchasing power. So remember, you guys, utilization ratio is king. It only applies to credit card, and the max it is 30%. If you go over 30% of your credit line, your credit score will go down. This is the most important thing for anyone out there that is either struggling. If you're struggling, if you're overwhelmed, you can't ever get out of the situation, your credit score is 560, you're late on rent. Chill, guys. Chill. Okay? Reset up your lifestyle. Pay one credit card down at a time. That's why I'm telling you this, okay? Start with one credit card. 30% utilization ratio, it will help you. Don't worry, okay? But don't beat yourself up. Now, number 2, okay? Remember, whatever bills is what's reported on your credit. It's so important to know that. You have to know when your balance is reported to your credit, because remember, the balance on your credit cards affect your credit score. It's called utilization ratio. We just went over it. So if you ever want to play the market, if you want to play the timeline, understand that as long as you pay credit cards down under 30% prior to that credit card billing, you're okay. So remember that. Whatever is bills is what's reported to the credit bureaus. Number 3, this is a good one. This is a good one, you guys. Yeah, this is dangerous. This one's dangerous. So be careful and listen when I tell you, okay? This is a dangerous one. Co-authorized accounts. It's a huge loophole. It's a huge loophole in credit. If you guys are struggling and you want a credit score, if your credit score is 700 or lower, so again, if your credit score is 700 or lower and say your spouse has a credit card that you don't, listen to me, say your spouse or someone close to you has a credit card that you don't have, but, and there's a huge but here, but that credit card is in excellent standing, meaning no late payments, utilization ratio 1-2%. If you get what's called co-authorized on that account automatically reports on your credit profile as if you had that account the entire time. It gives you a massive credit score boost if that account is in great standing. Okay, so remember, and I know it's a little trick. Okay, it is what it is. I'm from the ditches, you guys. I'm from the gutter. I had to crawl my way out of the gutter to get where I'm at today. I'm giving you little tips here. Co-authorized accounts can give you a massive increase in FICO score or credit score. Remember that, co-authorized. But it's dangerous because you also get control of the account. So that's why I said your spouse, right? Not some random stranger or your good friend, probably. Now, number 4, okay? This is crazy. Listen to what I'm saying. And I got heat for this last time. I'm just saying, sometimes I know I'm going to get heat for this. I know I'm going to get comments. But listen, you guys, trying to give you a boot up or leg up here. If you pay your collections off, if you have a collection on your credit report, there are some situations where it can hurt you. I got roasted in my comment section for some people that I respect. They're like, Trav, how could you tell someone not to pay their collections? It's because they already hurt you. If you have a collection on your credit, it's already done the damage. There's generally no advantage to paying a collection off once it's hit your credit. The advantage is paying it off before it gets to collection. If you don't do that, it's almost too late. So understand, a lot of people are like, you know what? I'm going to pay my collections. I have $10,000 in collections. I'm going to be a great person. Just understand that that's all you're going to be is a great person to them and their profit margin. Okay. That's really all you're going to be a good person to, because it's generally not going to help you. There are situations where they can categorize collections and have it, and this is a huge violation of law, in my opinion, but they categorize collections as a revolving debt. So it looks like if you pay them, your credit score will go up. But I'm going to tell you guys, be cautious if you're going to pay your collections, because generally it will hurt your credit. Now, number 5, if you're struggling on the sideline with your credit, okay, this one's for you. Number 5, if you're lost right now, if you're drowning, you don't know where to start. How do I become a homeowner 3 years from now? If this is you, the number one thing you need to do right now, to the best of your ability, and I know how hard this is because I was you. Remember that if anyone could buy a house, if I could buy a house, then anyone can. But number 5, you have to stop the bad from happening. If you're in the process of increasing your credit, you want to buy a house, take that motivation and push yourself, yes, but none of it matters per se. Good habits do matter, though. None of that matters unless you stop bad things from happening. If you guys continue to allow payments like utilities to go into collection, your credit's just going to keep getting messed up. If you keep charging your accounts recklessly, your credit's going to keep getting messed up. If you're late on your credit, it's going to keep getting messed up. You have to start the bad from happening. Now, last thing. Okay, last thing. If you're overwhelmed in debt, say you got 15 credit cards, you don't know where to start, okay? Understand that each credit card, this is the last thing, each credit card is reported individually to the credit bureau. And it does not matter the balance. So if it's a $10,000 balance compared to a $1,000 balance per se, what matters is the utilization ratio. It's not necessarily how much you owe, okay? the reason why that's so important is you want to generally start from if you're overwhelmed in debt, you want to start from your lowest credit card and work your way up. You see? Because if you pay your lowest credit cards down under 30% first, that means that trade line is giving you a credit score increase every single month as you're working on the other debt. Does that make sense to you guys? I hope it does. Now, let me see if I can get any questions here. Was there any questions, you guys? I don't see any questions. Okay, so here's one right here. But if you guys, I'll look at the comment section now if you guys have any questions. Okay, so he's saying, okay, so let me talk about this one. He's saying, Ray's saying, get a credit card lawyer and settle. I used to be, Ray, in something called debt settlement, okay? Because, again, this was back in the day, mortgage, I lost my job. So I went into loan modification and debt settlement. I won't lie. I'm super embarrassed to admit that. But I could tell you guys that you don't need a lawyer to settle your debt. You just need to call them and work something out. And generally, if you work something out as far as like collections, you guys, and settling your debt, generally you can get them to accept, generally, from my experience on my own stuff, 50 cents on the dollar. And I didn't need a lawyer to do that. The thing is, Ray, it's just like when I was in debt settlement, they required like a $5,000 fee first. So that's why I don't believe in debt settlement, because you have to pay the lawyers before they help you. And it's a substantial amount of money. All right. Let's see. Do we have any other questions, you guys? Garnishment. I see garnishment. Oh, here's a question. Appreciate the question. Don't move. Credit question. Explain front and back. Good one. Front, back end DTI and what type of accounts on your report fall into each bracket. So what he's saying, debt to income ratio is a qualifying factor for mortgages. Debt to income ratio greatly impacts your purchasing power. So it's really important to understand how debt to income ratio works. And when we talk about front end and we talk about back end, the reason I don't, when I do little breakdowns, I don't give you guys front and back is because it's confusing. But what it means is basically the front end is like your total mortgage payment divided into your gross income. And they don't use net income. You guys, these unaffordability rates that we're saying is generally going off of gross income. They're not even going off of net income. So the front end ratio basically is your total mortgage into your income. And the total mortgage, what I mean by that, don't move, is your principal, interest, taxes, insurance, and HOA. Even though your HOA is not included in your mortgage payment, it is included in the front end DTI ratio. Now, your back end is important. Your back end DTI, which I talk about a lot, is your mortgage payment proposed. Everything is a proposed mortgage payment plus all of the debt on your credit report divided by your gross income. But also some of the things that are not on your credit report, like any payment plans to 401k can hit your DTI. So be careful with payment plans to 401k, child support, alimony. If an underwriter catches that you have SBA loans and they're coming out of your checking account, which is a small business loan, that can hit your DTI, even though that's not on your credit. So good questions, man. Let me go to the next one. This is, appreciate the question. What to do if keeping pre-approval updated keep hurting but not recovering points? So this is what he's saying. He's saying, Travis, how should I keep it's called a conditional qualification letter, pre-approval letter. I know what you're saying. How do I keep, depending on if it's an underwriter or a loan officer, so it actually can't be pre-approval if a loan officer underwrites your income in advance. But anyways, he's asking, do I keep letting them run my credit, right? Because each inquiry, Nightcree, let me explain how inquiries hurt your credit for loans. Each inquiry, or when a mortgage holder runs your credit, can drop your credit score. The last I heard was from 5 to 7 points. So he's like, dang, Travis, like, should I keep letting them hurt my credit? And here's what I say. No, you should not keep letting them run your credit. What you should do is you go, in my opinion, you go through the full pre-approval or pre-qualification process first. Let them run your credit. And then you just hold and you sit, okay? And so long, listen, this is so important what I'm about to tell you. So long as there's nothing changes on your credit, you should be okay. But if something changes, if you keep using your credit cards, if you keep charging up your credit, collection, late payment, yeah, you got to have them run your credit again, right? But listen, if nothing changes, you're okay. And how do you monitor that? Remember how you monitor that. You go to multiple things, annual credit report. I use Credit Karma. Credit Karma has a different credit score because it's a different algorithm. That's okay. Generally, it's too high. Generally, if you run your credit and mortgage, your credit score is lower than what's on Credit Karma. All right, guys. Lexington Law is a joke. Do not use Lexington Law. It's not, dude. Like Lexington, and I like this. You have some of the comments that you were saying, man. But I know specifically Lexington Law, and I'm going to tell you guys. Let me tell you what Lexington Law is a credit repair company essentially, and basically you pay them in a monthly, generally a monthly due. And if you can, first infantry, tell us what the due is. I can't remember what the due is. I think it's like 100 and something a month. But dude, all they do is they dispute your counts. So they send dispute letters to you, to your credit providers, and it makes it appear that your credit score goes up. But remember, brother, you cannot have disputes on your credit if you're purchasing a house. If you have disputes on your credit, you're purchasing a house, the underwriters will make you remove the disputes before you're even qualified. And they do that because they know your credit's going to go straight downward. But I will say this. If you can allow Lexington Law to have like 3 years and work on your credit, it could work. I'm glad you brought up Lexington Law, man. Like I used to talk about Lexington Law all the time. It's funny that you knew that. I'm impressed. Couple more questions, you guys. Question: how do I increase credit when when have no blemishes on account? Was 80 paid off 2 accounts, now 720. So I'm going to tell you right now that just because you pay down an account, that's not going to lower your score. So there's something else that happened for sure. Now, in this situation, if she paid off her accounts and then closed them, tell us if you closed them, Cassie, if you can. If you closed your accounts, you just destroyed your credit. You shot yourself in the foot. When you pay your credit cards off, you guys, you never, ever close the account. If you close the account on your credit card, your credit score will go down. I'm not sure, Cassie, if that happened. But I could tell you for sure it's not going to happen just because you paid your card down. So, and I hate to say it, but you may have had even a collection. I would be curious to see your credit report. I can actually tell you, if you want to email me your credit report, put in the subject line "credit report from the morning live," and I'll look at it. I'll tell you what happened. I love reading credit reports. Good question. All right, I think, is that it? Credit question. I almost threw that up, Johnny. I almost threw that up, Johnny. Oh, good one, Johnny. Oh, he almost got me, you guys. Bankruptcy is very bad for credit. I had a bankruptcy. It is very bad for credit. Also, student loans cannot be gotten rid of through bankruptcy unless it's a private company. Most all school loan is government, and you guys cannot walk away from school loans. That's one of the rare debts you cannot walk away from. Also, SBA is one as well. A soft pull, Twisted Tech is talking about soft pull. That's called a credit refresh. Generally, when you do a soft pull Twisted, like a soft pull is fine, a soft pull won't hurt you. That's actually a good point. So back to the other question. I mean, you can have them do a soft pull, which is basically updating the balances. So soft pull will update your credit balances, but not your credit score. Good one, man. That was good. I have to ask you guys a question too. I'm really nervous about something. I think that's about it. So running credit, yeah. Good point. You guys, what's this say? 3 years, it drops off. Now, pay your lawyers. Okay, so here's the thing, you guys. Oh my gosh. Let me throw this up here. I got behind on the comments. So if you check what your credit is, that is a hard pull, isn't it? Ray, not if you go to freeannualcreditreport.com or if you do what I say and use Credit Karma. This is one of the reasons why what Ray is basically saying right here is why I use Credit Karma. I know that Credit Karma is not going to give me a 100% accurate FICO score, but I use them because it doesn't hurt my credit, and I can constantly monitor my credit because Credit Karma actually updates every 7 days, and it doesn't give me a hard pull. So, Ray, good point. The hard pull is, but I still think the hard pull is necessary at first. I think that the first, time you get qualified for a home loan, like the first round, I think a hard pull is worth it because you need to know where you stand. If you don't know where you stand, then you're not going to know if you can get a house. And it's not just about credit. Remember, it's also about income, and income is very, very complicated sometimes. That does backflips. Well, I don't want people to get hurt, man. I just want things to get back to normal. So removals work if for example, Lexington Law, like Infantry was talking about, like Lexington Law can get like certain derogatory information removed from your credit report. Here's the big if: you can prove it was a mistake. And I got to tell you guys, I have personally on my own credit fought this battle, and I have won once. It is a complete nightmare. If you can't prove, like without beyond a shadow of doubt that they weren't mistaken in basically violating the law, their Fair Credit Reporting Act that they're required to follow. Ever hear of it? It's so hard, man. So, you know, you got to prove it. If you weren't really late, you got to show them payments, confirmations, things like that. It's very, very difficult to do. What? Credit Karma updates daily. I did not know it updated daily. So it's not 7 days anymore. That shows you how much I've been following my credit. My credit's bombed, so I really don't follow it too much, and I have like no debt. So, all right, you guys, I have a question for you. That's going to wrap it up. That was our credit section. I hope you guys enjoy the value part of our videos. I'm going to try again to inject value in each and every one of my, especially my live videos, part of my way of tricking the YouTube algorithm. But I want to ask you guys something. I'm thinking about, after this live, I'm going to do a video on basically malls and how malls are losing like 50% right now in value. And I'm thinking about going, so there's a mall probably about 20 minutes from my house. It's the Greenspoint Mall that appears like it's abandoned. So I'm thinking about doing an on-location live at the mall. So nervous about that because I haven't tested my audio, haven't tested the lighting. But let me know if you guys think that's a good idea, if I should do a live on location at the mall with my GoPro. I'm freaking out about it. So I don't know if that's a good idea or if it's just, I'm just wasting my time, but I think that you guys would like it. Malls are dying fast. You know, malls are dying fast, but Mark, I see you out there, Mark. Appreciate your loyalty, man. Appreciate you just for always commenting, but most importantly, Mark, I appreciate you being solid commenter, man. I see you commenting, you're solid. So look at, I mean, see, they know, please don't get robbed out there. You guys, this is a crazy mall, I heard. Guns Point. Yeah, it's called Guns Point. That's the nickname, Guns Point. So I'm going to be going there. And again, I may do a live on location. There's just so many challenges of doing live videos out of my studio. And I don't, good video. I mean, a couple of people want me to do it. I don't know how many. I may not do a live unless you guys really want me to. I don't see too many people. But anyways, you guys come back, reference this video. Everything's going to be time-stamped here in a minute. And have a great day. Look forward to talking to you in the days to come. And obviously, you guys, if you're out there investing in real estate, I do wish you luck. And I hope you win.